Good morning, everybody. Hope the week is treating you extremely well. In this week's video, we are going to take a look at the major four U.S. indexes. We're also going to take a look at the U.S. dollar. We'll take a look in at the emerging markets, and we're also going to take a look at the precious metals complex, gold and silver, as well as taking a look at oil. So a lot to cover in today's video, so let's get right to it. Yesterday, the Fed hinted that they would not be opposed to cutting rates if economic conditions essentially warranted it. They did not change the rates at yesterday's meeting, but the market seemed to like that as we now have gapped up overnight at those all-time highs here on the S&P 500. So let's go back and let's talk about when we were about right here. Back in April, I said what we didn't want to see, if you were bullish, was a break above that all-time high and then an immediate failure underneath. And we saw that, and of course we had that nice pullback that lasted almost 2 months and found support right at the level that we had talked about in numerous videos right here. So really what we have done, if we take a look here, we have double bottom, and right now we are from the highs that were put in the beginning of May, we're like a point above them. So this is not a clean breakout at this point in time, but it certainly looks like the market has the potential here to make that push. And if we do make that push, you can look at this again as this two-step forward, one step back, and then your next move essentially is to the upside. So what the bulls really want to see here is we really want to see the market hold over that 2950 level on the S&P 500. That would be very constructive, and that really would, if we want to take a look at some upside targets here, if we take a look at our fib extensions, where we go from the last low to that breakout spot right here at 2960, that gives us a target midterm of about 3250. On the S&P 500, and from where we are currently at right now, percentage-wise, it's about a 10% move here to the upside. So that's really what we're paying attention for. However, we have not clearly made that breakout. I want to make that point very clear in this video. We are right at that level, and we saw what happened back in May. We ran right up into this resistance zone. We ticked just above it for a day, and then we immediately fell back underneath of it. So bulls really need to get up over this level and hold over it here for a few sessions and continue to grind higher. And that's what we're going to be watching for right here. Take a look in at the Nasdaq. The Nasdaq is just below the highs that were put in back in May. So again, same zone where we found support right at those lows from back in March on the Nasdaq. Same concern that we talked about when it pushed to a new high there at the end of April. Can it continue to push above that, or was it going to subsequently turn back down? We have basically the same setup here as on the S&P 500. Two step forwards, one step back, trying to make that push. The key, of course, on the Nasdaq is going to be if we can kind of push over that 7,900 level and hold over it. When we take a look in at the Dow, Dow has not made a new high all year. It was weaker back in April. It came close but did not push up. It actually broke, and I'll put the 200-day moving average on this chart so that you guys can see it. It was underneath the 200-day moving average where we did not have that action for more than a session or so on the S&P, and same thing on the Nasdaq. But on the Dow, we traded under it for almost a week, and we actually broke underneath of it well before the final push back in the middle of May. So it has been a weaker index, and we can see same type of area of support, but it did break underneath of it. So we were really watching the Dow very closely back here because it was leading us to the downside. Well, obviously, we'll talk about the Russell here in just a second and how weak that has been. But the concern was, of course, it'd be very difficult for the markets to continue to rally if the Dow continued to break down. However, just like all the other indexes, it held right there. So we're just a couple of points away from those all-time highs here on the Dow. Same kind of thought process. One step forward, two steps forward, one step back. Maybe we have that potential two-step forward push there as well. We're going to need to get up over that 27,000 level, hold over that, and continue to push off of that zone. Now, we take a look in at the Russell. Just got up over the 200-day moving average 2 days ago. So again, it's been the weakest index here for quite some time, continues to be weak. We did push over that 1600 level on the Russell there for a session. That's where it had its failure. If we looked at where the previous zone of support was, you can see we broke underneath of it and traded under it for 4 or 5 days. That next zone of support was right there at that 1450. We did lay that out in one of the videos, and that is ultimately where it held. You would need to see a break back over 1600 and hold, and then it's the only one that has major resistance still to go if it were to get over this first hump here, and that's back up at 1750. That all-time high. So it has broken down earlier at the beginning of last year, fell further, failed at the 200-day moving average, has traded the majority of the last 8-9 months underneath the 200-day moving average, which is still sloped down, still by far the weakest area of the market in terms of the 4 major U.S. indexes. It's very tough for us to really rock and roll without seeing the Russell participate. So we're going to be paying very close attention to that 1600 level and see if it can join in on the party, so to speak. Now let's take a look in at the U.S. dollar. We've talked about this a lot. You can see the lines we have subsequently put on the chart in previous videos. We talked about this 98 zone. Can it get up over it? And we'll zoom in a little bit here so you can see it. This is one of the things that we talk about. Resistance is a zone. It's not just one single number. And so when we look at what the U.S. dollar did here over the last month or two, there was a couple of times it poked up over that resistance line, never closed above it, and immediately was knocked back down. So you have kind of multiple levels of failure there, and this level of resistance was very, very important going back for 5 or 6 years. Now, when the U.S. dollar subsequently gets weak, that does a lot of things for things that are priced in the U.S. dollar. So commodities tend to have a tailwind behind them. We'll take a look at gold, silver, as well as oil here shortly in this video. And the emerging markets as well. When the U.S. dollar is weak, the emerging markets tend to subsequently perform better. That tends to be that tailwind, right? It's not 100% of the time if the U.S. dollar is falling that those things are going to go up, but it just gives the extra oomph, so to speak, to those areas of the market. So the U.S. dollar is sitting right here on this 200-day moving average. This right here, this low that was put in back on the 7th of June, that's the short-term zone that we've got to watch here on the U.S. dollar. A break underneath of that would open up kind of a run back to the lows from the beginning of the year in at that 95 level. That's kind of how I see this right now. It's still barely holding on to that 200-day moving average, has not made a lower low yet. If it were, again, to take out the low from the beginning of June, you would then have lower lows and lower highs, and that would be a short-term downtrend that would get put in place. But as it sits right now, that's not the case. So again, we need to watch this level. So the June lows are really going to be telling for us here. Now, let's take a look in at gold. Gold, and I'm going to back this chart up so you guys can see this in on a monthly time frame, right? This is a 20-year chart. We had a huge run-up, and then we have fallen. Gold essentially has traded in between 1,400 and about that 1,000 level now since 2013. So it's been 6 years. It hasn't really done very much, but there's one thing that it's done that's been very constructive, and that is every low has been a higher low when we look at this in on a monthly chart. So originally we bottomed out at about 1,050. The next low was put in at about 1130. The next low was put in at about 1180. So we have a series of higher lows, and we have basically had a resistance level right in at about that 1350 zone on gold. So this pattern right here is one of my favorite patterns. It's the ascending triangle. And the reason why I like it so much is because the resistance level stays the same, meaning people are taking their profits and sellers are stepping in at that same level, but they are not, buyers are not waiting for price to fall all the way back to the previous low. They don't think it's going to. They step in sooner and sooner, and that's bullish behavior. And so when you get a breakout, which is what we have currently at the moment, these tend to be powerful and they tend to make some solid moves. So if gold can hold over that basically 1350 to 1360 zone that's been resistance, and I'll zoom in here so you can see this on a weekly chart, if we can hold over this level for a couple of weeks and continue to grind higher, be a very constructive, very bullish. The other piece you have with this is you have what could be construed, and we've talked about this as well, as a cup and handle that has been put in over the last year. So you have that nice cup, the handle, the breakout volume came in on it as well. So gold does look very good at this point in time, and we'll see if it can obviously continue. And a lot of that would again have to do with the U.S. dollar. If the U.S. dollar continues to be weak, this should be an area of the market that continues to do well. Silver has not made a major breakout yet. And let me back this up so you can see this in here. I'll clear all these drawings out so you guys can get a good picture. Same type of setup where really it hasn't done much of anything since 2013, but it's not the same clean level base. We do not have a set of higher lows getting put in or a flat top. We have a set of lower highs getting put in and basically a flat bottom. So almost the inverse of gold, where instead of having an ascending triangle, we have a descending triangle. That's not nearly as bullish of a pattern. Over the long term, these two are going to trade very similar to one another. So if gold does continue to make its move higher, I would be surprised if silver didn't also follow through. But there's a lot of technical levels and hurdles that this has to get through. It does not look nearly as good as the gold chart. So we're not even at the highs of this year, whereas gold is at the highs of the last 6 years at this point in time. So the key level really in on silver to really get this thing going would be the highs from earlier this year. That's about that 1620 zone. If we make a break above that, I would fully expect to see a higher, longer push and really back up into that 18 level would be the next target in on silver. Let's take a look in at emerging markets real quickly. We have talked multiple times about this box on box action here that we have seen lately. We are once again back into the top box. That 1020 level on the emerging markets is the important level. We're back up here at 1040. So as I said a couple weeks back, if we were able to get up and close over that 1020 level in on the emerging market index, I would think that the next test would be to run back up towards that resistance level at about 1100. And so far it is continuing to push up. Again, with the weaker dollar potential here as well, that would be a tailwind for this, and that could also see some continued push to the upside. So I would pay attention to the emerging markets as well here. I think there's some good opportunities. Last but not least, we will talk about crude here. I'm going to clean all these drawings out. We're going to talk about fib retrace level that we have subsequently just bounced off of. So if we go and we take the low to the high that was put in back from December to the high that was put in here in April, we get a couple of fib retrace levels to take a look at. And we talked about that 61.8 level as being important, and we talked about that 50 level as being important. So basically, the way that I was looking at this market here is we were trading, and I'll clear the fib extensions out so you can see this a little bit cleaner, right? We came down, we fell to support, here was resistance, we traded back and forth inside of it for a couple of weeks. We were looking for either a break above 54 to take a run back up to some resistance levels, or a break kind of underneath that 50 level, and that would really have opened us up for the potential to go test those December lows. Where we're sitting at currently right here, the next resistance point in on oil is a big one. It is at 57.80 to 58 level, and this has been the key inflection point here for the last year or so. We can see it played a very important role back in November. It played a very important role as resistance in February. It played a very important role as support in March, and it did hold again as support back in May until we broke underneath of it. So this is that key level. Bulls really would like to see oil back up over that 58 zone, and that is the area that we're going to be paying attention to. So once again, here we are at all-time highs on a couple of the indexes. The Nasdaq is just shy of it. The Dow is just shy of it. The S&P 500 is making that new high. The Russell is still, once again, way away from it. We've got some weakness here out of the U.S. dollar, so pay attention to the commodities. Pay attention to the emerging market space. I hope you guys have yourself a fantastic week. And as always, I'll see you guys next week. Take care.